Hello and welcome. In this lesson we will continue our lectures, and we will now look at corporation tax. Corporation tax is our last syllabus area. If you remember from your first lesson, when we started P6, I mentioned the topics in the board. There was something called income tax, which we started with, and it was a huge syllabus area. It took us ages to complete, and some of the students were very worried about the syllabus, whether we will be able to cover the syllabus or not. And then we looked at capital gains tax, which was our second syllabus area. We then looked at inheritance tax, which is another capital tax, and we then moved recently to value-added tax, which we have finished recently. Right now, this corporation tax, some of you might be thinking it is a huge syllabus area, like income tax, but it is not like that. Although it is very huge, if we look at the scope of corporation tax, it is very huge, just like income tax. But because we have already seen most of the bits and pieces in income tax, we don't need to look at that here again, because they are exactly the same. Say, for example, if we talk about property income is exactly the same in income tax and corporation tax. So we won't look at the corporation, we won't look at the property income again, because we have already seen the property income. If we talk about capital allowances, we have already seen the capital allowances. We won't look them again. We won't look them again. The only difference for about capital allowances of individuals and companies is, if you remember, when we used to make the pro forma of capital allowances on the board, we used to make one pool, which was main pool, then special rate pool, and we used to make another special column for private used car, right? So where the owner has used the car privately as well as for business. All right. Now, if you remember, why were we doing it? Because the owner was using the car privately as well as for business purposes. And if you remember, we were only taking proportion of what it was used for business, and we weren't taking any portion for private use. If we look at the company's perspective, could you tell me that who are the owners of the companies? Yeah, shareholder are the owners of the companies. Now, if the shareholder is the owner of the company, shareholder won't be present in the company. They won't be using the cars. They won't be using any benefits in the company. The people who are responsible, the people who will be doing the stuff in the company, who will be present in the company, are the directors. Now, directors may be using cars, they may be using facilities. But if you remember from capital allowances, a private use of the employee was not private use. Private use of the owner was private use, right? So just like here, a private use of employee, because directors are employees, so we won't take any private use of capital allowances, private use of cars in companies. So this is the only difference. All right. So apart from that, it is exactly the same in capital allowances. So just like I said, that it is most of the bits and pieces we will see. We should be looking at, but we are not looking at because we have already seen them. If I would have started with corporation tax, then I would definitely have covered them syllabus areas. All right. Now, if we talk about corporation tax, corporation, it says companies tax. So, like if you remember from income tax, we used to make a pro forma of income tax. So we will make the pro forma in corporation tax as well, but it is not as complex as for income taxes. Excuse me. If you remember, in income tax, the main complex thing was not only to make the pro forma, but another thing was different banding and different tax rates. Although they will be given to you in the exam, but you will still have to waste some time in the exam as well. So in order to look at the rates, in order to look at which band is your income falling. All right. However, as far as the corporation tax is concerned, there is only one standard rate of corporation tax, which is 20%. So you don't have to worry about 20%, 40%, 45%, 32.5%, 37.5% like income tax. There's only one standard rate of corporation tax, which is 20%. Right? If you remember from income tax, when we used to make the pro forma, there was one source of income was interest income. Now interest income, if you remember, we used to gross it up because we used to receive it net. So whenever we are receiving it net, we used to gross it up. As far as interest income in companies is concerned, we always receive it gross, so we do not need to gross it up. So we want to receive it net, so we'll always receive it gross. So that's why we will just take it as it is given the question, because it is received gross. So no grossing up needed as far as interest income is concerned of companies. There is another major difference. If we talk about trading profits are exactly the same in corporation tax as well, and because we have already seen the trading profits in income tax, so they will be exactly the same here as well. However, there is one difference I will tell you in a minute. If you remember that the one major thing which we have seen in income tax was basis period. Now the basis period was very complex and very time consuming, and some of you might have spent hours to understand what the basis period are. So we don't have to deal with the basis period here, so you don't have to worry about that either. Alright, so I will just go and share the screen with you so that we can start our new topic, which is corporation tax. I've already shared the screen with you, so I will be talking with you and we will discussing from the notes as well. Alright, now trading profit, as I said, trading profit will be exactly the same. However, there won't be any basis period, so the accounting period will be so we'll take the accounting period profit and we'll have to calculate tax on the accounting profit. We won't be worrying about making the basis period. We won't be dealing with the stuff like first year and the second year and the final year of trade and all that. All right, so there will be no basis period or first basis period or something like that. So because we don't have to deal with the basis period, so the accounting profit which will be given to you in the exam, you have to take straight that, so you don't have to do anything with it. So it will be exactly what you have been given in the exam. If we talk about capital gains, now capital gains tax, we have already seen that as well. So that will be exactly the same in corporation tax as well, right? Now what happens is, as I said, we will calculate the tax according to the accounting profits, but accounting profit will be according to accounting date, isn't it? So whenever a company has started the business, they are making some accounts, right? So when they are making some accounts, I hope that you would appreciate the fact when I told you when a business starts the business, then they don't look at what to make the accounting date. So they are just concentrating on the business. They're not thinking about to make a proper date which is compatible with the tax years, right? So say for example, if a business has started and initially they have made accounts to 31st December, which was 12 months, right? So they were making accounts to 12 months. Now they might make the accounts for 12 months, they might make the accounts for less than 12 months or more than 12 months. So we never know. It is up to the company. Now the accounting periods which are more than 12 months long are called longer accounting periods. So ones which are longer than normal accounting period. Normal accounting period is 12 months long, isn't it? So if it is more than 12 months long, it is called longer accounting period. However, if it is shorter than a normal accounting period, say for example, if it is less than 12 months, then it would be called as a shorter accounting period. Right? Now what happens is that because in corporation tax we pay tax according to the accounting dates, so although we pay according to the accounting dates, but accounting date could be more than 12 months. Now say for example, if accounting date is more than 12 months, then what we have to do is in corporation tax we only make our accounts to 12 months. So taxable accounts will be for only 12 months. Say for example, accounting period is more than 12 months of a company, say for example 18 months long. If accounting period of a company is 18 months long, then we will have to divide that accounting period into two periods for taxable purposes. Now if the company has started trading on 1st of January and 1st of January 2013, and it is making its account from 1st of January 2013 to 30th of June 2014. Now these are 18 months. Now the company is making accounts of 18 months. In this case, what we have to do for taxable purposes, in order to calculate corporate tax, what we have to do is we have to take first 12 months. So that will be our one account for taxable purposes, and whatever the remainder months are, that will be another accounting period for taxable purposes, and we have to make two sets of accounts. All right. So what I said, that when the accounting period is longer than normal, say for example more than 12 months, then we have to take first 12 months. That will be our one set of accounts for taxable purposes, and we have to take remainder months. That will be our excuse me. That will be our second second lot of accounting period, right? So we will have to divide the accounting periods into two lots, where the accounting period is longer than normal. Anyways, let's look at notes now. I think I've already told you much, so let's look at the notes now. Another thing as well, if we hang on, I will tell you when we move to that. So let's look at the notes. It says corporation tax, accounting profits. So how can we do that? We'll have to take trading profits. We know what trading profits are. It is exactly the same way. We will calculate exactly the same way like we do in income tax. Then the interest income, we'll see in a minute how to calculate it. The only difference is that we do not have to gross it up. I told you we do not have to gross it up in the companies like we used to do in income tax. So we'll just take as it is given in the question. Another thing is that there are some difference in income, in interest income. Say for example, if you have taken a loan for trading purposes and you are paying interest on that, then what you have to do is you have to deduct interest out of the trading profit. You remember? So say for example, if you have taken a loan and you are using that loan for trading purposes, now because this is interest paid on loan for trading purposes, so we'll have to deduct it out of the trading profits. Say for example, if you have taken a loan and you are not using that loan for trading purposes, so it is not using for trading purposes. If you're not using for trading purposes, then you have to deduct that interest out of the interest income, right? So that is called in the non-trading loan relationship. I will tell you in a minute as well when we move to the interest income. It is called non-trading loan relationship. Now, after interest income, it is property income. We know property income, how to calculate it in capital gains as well. Now, whatever the total is, we have to deduct the qualifying charitable donations. Now, whenever you make some donations, you'll have to deduct it out of here. And the remainder will be taxable total profits, and we have to pay tax at the rate of 20%. As I said, in companies, there is a standard rate of tax. Now after that, it tells us some notes. I'll just move the screen. It tells us some notes. Note 1 is a dividend. Now companies, whenever I have a company, say for example, and that company holds shares in another company, if a company holds shares in another company, then the company will be getting some dividends as well. The companies do not pay tax on the dividends. That's what it says on the notes as well. Companies do not pay tax on the dividends received from other UK or non-UK companies, and gross dividends are also called franked investment income. For taxable purposes of corporation tax, we will call dividend as franked investment income. Alright? And after that, it tells us interest income. Companies receive interest gross, so no grossing up needed. If company pay interest on loan other than for trade purposes, so non-trade purposes, then the non-trade interest paid is deducted from interest income. This is called non-trading loan relationship. I have already explained you. And if interest is taken for, and if interest paid on loan taken for trade purposes, then it will be deducted out of the trading profits. We already know it. Now, as far as trading profits are concerned, same adjustments which we have already seen in income tax and capital allowances as well. The only difference is that as far as capital allowances is concerned, that there will be no treatment for car with private use, and no basis period as well. Property income and capital gains are exactly the same, which we have already seen. Now let's go to the next page. Let's come to the next page, which is accounting periods. Now, accounting periods, as I said, it could be of 12 months, or it could be less than 12 months, or it could be more than 12 months. The 12 months one is called a normal accounting period, and one which is more than 12 months is called longer accounting period, and one which is less than 12 months is called short accounting period. Now, if the short accounting period will take exactly the same, which will be shorter. If it is 12 months, will take exactly the same. If it is more than 12 months, say for example, if it is 18 months, then we'll have to make two sets of accounts for taxable corporation tax purposes. So first one will be first 12 months, and the second one will be 6 months in this case, because in this case the accounting period of account is of 18 months. Now, what is period of account? Period of account is what the companies are making accounts of. So for example, if the company is making accounts to 18 months, so it will be called period of accounts. However, accounting period is called our taxable period of which we have to pay tax. So period according to which taxable total profit is calculated. So if it is more than 12 months, we'll have to make two sets of that. All right. So let's move forward to the next page then. That is called self-assessment. Now, self-assessment for companies, we've already seen self-assessment for individuals in a couple of lectures before, I think. However, as far as for self-assessment for companies is concerned, that's here. Now, what are returns? You already know the income tax return. As far as companies are concerned, they have to submit the VAT return as well. They have to submit the tax returns as well. Now, tax return date is 12 months after the end of accounting period to which the return relates. Say, for example, if your accounting period is ending on 31st December, so it will be 12 months after that. Now, if they do not submit their VAT return on time, and it depends on if they do not submit the VAT return on time, so they are late. It depends on how late they are, and accordingly the penalties will be applicable. Now, the penalties are different. If you see, there are three tables here. First one is return late by time, so the time how long they are late. So in the first case, it is up to 3 months. The first penalty is for first and second consecutive failure. Now, say for example, if it is your first time that you are being late in the submission of VAT, tax return, if it is your first time that you are submitting the tax return late, then this penalty will apply, and if it is up to 3 months. If it is second time, then this £100 will apply as well. However, now look at the next table, which is 5 times higher than first table. In first table it is £100, and in the second table it is 5 times higher than what it was in the first case. So in the second table it is £500, and this penalty will apply if it is third or subsequent consecutive failure. Say for example, if it was your first failure, if it was first time that you have submitted the return late, and it was second time, so it will be £100 for first and second time. However, if it is third and subsequent consecutive failure, then it will be 5 times higher. Likewise, if it is more than 3 months and up to 6 months, then the penalty is £200 if it is first or second failure, and if it is a third or subsequent consecutive failure, then it is 5 times higher, and £1,000 in this case. And if it is more than 6 months and up to 12 months, then accordingly £200 plus 10% of tax, and 5 times higher, which is £1,000 plus 10% of tax. And in the last case as well, it is already mentioned, you can see it. Now, the companies must keep the records for 6 years from the end of accounting period. That is very, very important date. Please make sure you write it down. An examiner might ask you about that, and you may earn 1 easy mark. Now, payment of corporation tax. Now, it depends on how to pay the corporation tax, if it is a large company or a small company. Now, how can we calculate if it is a large company or small company? There is a formula to do that. How can we do it? How can we do it? Now, taxable total profit plus gross dividends. Now, what are the gross dividends? Franked investment income. So, if you're taking any dividends out of the company in which you hold some shares, you will take that profit, that will be dividends, franked investment income. Franked investment income plus taxable total profit, whatever it is. So, if it is £1.5 million or more than that, then you will be a large company. So what is it? total taxable profit plus franked investment income, which are dividends. So if your company holds some shares in another company and dividends are being paid, then them dividends plus taxable total profit of its own, if it is 1.5 million or more than that, your company will be large company. Now, if your company holds shares in another company and that company is a subsidiary of your company, all right, in that case you will have to divide that by how many subsidiaries you have. Now the subsidiaries in this case are 51% or more interest, as it says here. So that this limit 1.5 million will be divided by your company plus the number of subsidiaries. Say for example, if you have 2 subsidiaries, then this limit 1.5 million will be divided by 3. One yourself plus your subsidiaries, which are 2. So 1.5 million divided by 3 in case you have 2 subsidiaries. If you have more than 2 subsidiaries, then accordingly you will have to divide that. Now, companies which are large, and we know how to calculate, how to determine if the company is a large or not for taxable purposes. Now, when we know, then if a large company, if your company is a large company, then you will have to pay tax by installments. All right, how to calculate the installment? The formula is given: corporation tax divided by n multiplied by 3. Now, what is n? And our number of months. However, large company is not required to pay by installment in the first year unless its profit exceeds 10 million. So large company is not required to pay by installments in the first year unless its profit exceeds 10 million pounds, as it says in the notes in the first very left side. Now, interest will be paid. If you have overpaid, you will be paid 0.5%, so not 0.5% if you have overpaid. If you have underpaid to HMRC, they will charge higher interest rate, which is official rate, which is 3%. Now, if your company is a large company, how to calculate, when to pay the installments? The 4 installments. First installment will be 14th of 7th month in the accounting period. So 14th in the 7th month in the accounting period. Please remember the notes. Please remember the wording. 14th of 7th month in the accounting period. Now, we are looking at installments of a large company if accounting period is 12 months. All right. So we're looking at if the accounting period is 12 months. If it is less than 12 months, we will look at in a minute. Now, what about if it is more than 12 months? We can't calculate the corporation tax if it is more than 12 months. If it is more than 12 months, then we will divide that accounting period into 2 portions, which is the first one and the second one. So if it is 12 months long, then when to pay the installment? First installment will be 14th of 7th month in the accounting period. Second will be 10th month in the accounting period. Third will be 14th of the first month after the accounting period. And the last one will be 14th of 4th month after the accounting period. Alright, now if the large company has got less than 12 months in the accounting period, then the first installment will be on 14th of 7th month from the start of the accounting period. Alright, please remember the wording. Check the difference between this one and the previous one. 14th of 7th month from the start of the accounting period. And the second one will be 14th of the month, which is after 3 months interval of the previous installment. So say for example, if your previous installment, if your first installment was in 14th of August, then you will have to take 3 months after that. So August, September, October, November. Next installment will be in 14th of November in this case, because it is saying 14th of month, which is after 3 months interval. So every 3 months you'll have to pay next installment. As far as the final installment is concerned, it will be 14th of 4th month after the accounting period. That would be our balance in payment. Now, if say for example, if your accounting period is less than 12 months, what you have to do is you will have to take first installment. First calculate the date when you have to pay first installment. Then calculate the date which you have to pay the final installment. Now, the between 2 ones you can calculate later. Alright, so always do this approach. Always use this approach. First, if your accounting period is less than 12 months in corporation tax, then first you have to do is calculate the first payment, then calculate the last payment, which is balancing payment, and finally calculate the between ones, which are two payments, which are after the interval of 3 months after the first payment. Now, if your company is a small company, we were looking at the large company payments. If your company is a large company, we have to pay by installment. If your company is a small company, for 12 months accounting period or less than that, the date is 9 months and 1 day after the end of accounting period. 9 months and 1 day after the end of accounting period. Please remember that. As far as compliance check and discovery assessment, determination, appeals, amendment of errors, penalties for late notification and penalties for errors are exactly the same what you have seen in the self-assessment for individuals. Alright? Now let's go to, we'll leave this page, which is 77, and we'll leave the next one as well, and the next one, and the next one as well. So let's come to page 81 of your notes. Now we will look at the losses of the companies. Now the trading losses. Now look at this table. It gives us three figures here, which is first one is a crunch year. Crunch year is 2012. Then it tells us 2013, and it also gives us 2014. Now what we are looking at is trading losses carry forward. Now if you look at the first year, which is our crunch year, we have got a trading loss, then we have got interest income, other income, foreign income, property income, and capital gains. And after deducting the qualifying donations, what we have got is total taxable profits. And we have got, if we look at the 2013 and 2014, we have got the figures as well. Now what we have to do is, how can we use our trading losses? Now the trading losses can be carried forward in the next years if you do not have any profit in the crunch year to set off against. Now what does it say in the notes? Trading losses not relieved in the crunch year can be carried forward to set off against first available trading profit of the future year. Trading losses can be carried forward for as many years until the loss is relieved. So there is no limit for 3 years or 2 years in the future, as long as you, whenever you can relieve your loss until the loss is relieved in full, you can take it forward to as many years as you want. Trading losses can be carried forward for as many years until the loss is relieved. Qualifying donations not relieving in the year in which it is incurred will remain unrelieved. So qualifying charitable donations will be wasted because you will not consider that when you are relieving the loss. Alright? So that was a carry forward trading loss. If we look at the other type of loss on the next page, it is trading losses against total income. Now if you look at about the trading losses against the total income, what was the previous one? Trading profit against trading profit of future years. So the previous one was trading profit against trading profit. Trading losses against trading profits. Now this one, is trading losses against total income. Now what does total income means? Total income means any type of income. It could be employment income, it could be other income, whatever. So trading losses against total income. How can we do that? We can do it in the crunch year, and we can carry it back as well. In the notes it says trading losses can be set off against total income, but before gifted donations of the crunch year. If the company wishes, it can further carry back its trading losses balance, if any, against the total income of the previous 12 months. So first you have to do is in the crunch year, then you can take it back to previous 12 months. Any trading loss not relieved in the crunch year in the previous year can be carried forward. Now carried forward option is always available. First you have to do is you have to set off against crunch year, then you can carry it back. If that not happens, then you can carry it forward. So trading losses can be set off against the total income of the crunch year. First is crunch year against total income. Then if the company wishes, it can carry it back against trading loss, its trading loss balance, if any, against total income of previous 12 months. So this year and the previous 12 months against total profits, total income. And any trading loss not relieved in the current year and the previous year can be carried forward against trading profits of the future year. Now, when you talk about the future, that can only be relieved against the trading profit, not total income. Alright, then after that it says the claim for loss relief should be made within 2 years from the end of the accounting period in which the loss was occurred. As far as terminal loss is concerned, if the trade ceases, then the trading losses of last 12 months of the trade can be carried back. Let me move down the notes as well. I forgot. We are looking at the trading terminal loss. Last 12 months of the trade can be carried back to set off against a total income of the previous 36 months. Now, the terminal loss is the loss of the last 12 months. That can be carried back to previous 36 months on a last in first out basis. So that would be LIFO basis. So previous 12 months, whatever the immediate previous one is, then that one, then the previous one. So for example, if you have ceased trading in 2014, a LIFO basis would be 2014, 13, 12, and then 11. So that would be LIFO basis. A qualifying donations not relieved in the year it is incurred will remain unrelieved. All right. Now, in the next page, it says relief for deficit on non-trade loan relationship. The non-trade loan relationship I've already mentioned. When you take the loan for non-trade purposes, and you have to deduct it out of the out of the interest income. All right. So when you take the loan for non-trade purposes, and you pay some interest on that, that will be deducted out of the interest income. Say for example, interest income less interest paid is coming into negative. If it is coming into negative, that would be a loss. Now we're talking about the loss. Relief for deficit on non-trade loan relationship. A non-trade loan in interest deficit may be set off against any profit of the same accounting period. So it can be set off against any profit of the same accounting period. Any unrelieved non-trade deficit is carried forward to set off against non-trade profit of the future years. So if any still remains after setting it off against the current year, then you can carry it forward against the future year non-trade deficit. Future year non-trade profits. Other loss relief. Now the capital losses can only be set off against capital gains, as you know, in the same or the future accounting period. Property losses, property income losses are first set off against any other income, and the gains for the future current years. Any losses unrelieved is carried forward to set off against the income of the future year as far as property income is concerned. Alright. Now, a restriction on the loss relief. There is a restriction on the loss relief. A carry forward loss is only available against profits arising from the same trade in which the loss incurred. So the carry forward loss can only be available against the profits arising in the same trade in which the loss occurred. Say for example, if the company was trading in dealing cars and they have incurred some loss. However, after that they have started to make changes in their trading, and then they started to make some food. They started to make some biscuits and all that. So like baking stuff. So there is a change in the trading trends. Their industry was cars previously, automobiles, and now they are dealing with the food. So there is a change. So they cannot, if they started to make profit when they moved to bakery, if they started to make profit, they cannot set off the previous loss in the cars against this profit, because they have changed the trading. They have changed the industry of business. So they cannot do that. So there is a restriction on that. So carry forward loss is only available against profits arising from the same trade in which the loss incurred. Trading losses may be restricted where there is a change in ownership of the company, and now if there is a change in the ownership of the company and a change in the nature of trade within 3 years before or 3 years after the change in ownership. So say for example, like ownership of the company is changed, and there is also change in the trade in the previous 3 years or after 3 years after that, or after the change of the ownership, there is a considerable revival of the company's trading activities in that case as well. If the restriction applies, then any losses before change cannot be carried forward after the change. Similarly, any losses after the change cannot be set off against the profit of the date of the change. So before the date of the change. Now, if we talk about from the planning perspective, what we have to consider is that the earlier the loss is relieved, it would be better, because future is uncertain. We do not know what would happen in the future. It's always better to relieve the loss earlier. And an attempt should be made to waste least gift aid donations, just like a personal allowance in income tax. If you remember, we will always try to waste least personal allowance. So in corporation tax, we will try to waste least gift aid donations. Excuse me. Alright, so that is it for this lecture. I think I would just wind up the lecture here. We will continue our journey with the corporation tax in the next lecture. So we'll look at some more complicated bits and pieces. Alright, so that was it, and I will see you in the next lecture. Thank you and goodbye.